Why mortgage payments are not included in net operating income. Ever wonder why mortgage payments are always excluded from a net operating income formula in real estate investing? Doesn't it sound weird? You are not alone. It's one of the most common questions beginners real estate investors ask. So today, I'm going to explain to you exactly why net operating income does not include mortgage and why that is actually a good thing. So let's start with what a net operating income actually is. Net operating income is a measurement of how much income a property generates before financing and taxes. It focuses only on the property's core operations, things like rent, maintenance, property management, insurance, taxes, and utilities. So here's the big questions. Why don't we subtract mortgage payments from net operating income formula? That sounds weird, right? As a mortgage payment is the biggest expenses in real estate investing. Here's the reason why. Reason number one, it's because real estate financing is personal. Example, two investors can buy the same property, one with 20% down and the other with 50% down, and they'll have very different mortgage payments. If net operating income included financing, the same property would show two different numbers depending on the buyer. Some buyers buy property with mortgage financing and the others buys it with cash. The key point is we want net operating income to reflect the property, not the person's buying it. Reason number two, objectivity and comparison. Net operating income gives you a way to compare different properties side by side, regardless of how they are being financed. For example, a property with $20,000 net operating income and a property B with a $30,000 net operating income. Which property is better? In this scenario, you would instantly know that property B generates more income before debt without getting confused by a loan terms. Reason number three, appraisals and valuation tool. Appraisers use net operating income to calculate property's value using cap rate formula. If we included mortgage payments, this formula wouldn't work because that isn't tied to the property's value. It's tied to the buyer's financing deal. Reason number four, it is industry's standard. Lenders, REITs, developers, everyone uses net operating income without debt because it provides neutral, reliable way to evaluate a property's performance. It's like a business. Net operating income is the company's operating income. Mortgage is how you choose to finance the company, not of its actual operations. Now, this doesn't mean you should ignore mortgage when you're investing. You just need to use it after net operating income. So it's like cash flow equals net operating income minus mortgage payment. That tells you how much money is actually going into your pocket every month. If you want to know how your financing affects returns, look at cash and cash return instead, not operating income. So quick summary. Net operating income equals property's performance before financing. It excludes mortgage for objectivity and comparability. It's used to calculate cap rate and property value. Financing varies, property performance shouldn't. So the next time you're analyzing a deal, remember, net operating income shows what the property earns, not how you pay for it. Use net operating income to analyze the property. Use cash flow and financing metrics to analyze the deal for you. If you find this helpful, give it a thumbs up, subscribe, and drop a comment if you want me to break down cap rate, cash and cash, or discounted cash flow analysis in the next video. Thanks for watching and happy investing.